Hi guys, welcome back to the channel. My name is Dave and today I want to talk about the wheel strategy. So this is a simple option strategy for people that are new to options. And I find that a lot of people that learn about options, they start with this and they never leave. They're like, that's good enough. It fulfills what I'm looking for, right? It's a differentiator from my normal portfolio, my buy and hold strategy, and it gives me something a little bit different, right? It might give me a little bit of option premium income, maybe some price appreciation growth, maybe a stray dividend along the way. And it's different enough from my regular portfolio. I like it. I'm going with it. So today we're going to talk about this strategy and why so many people love it. If that is what you're looking for, please stick around. So first of all, what is the wheel strategy? And step one of the wheel strategy is to identify some stocks or ETFs that you actually really love. You want to love these things, and then we're going to sell an out of the money put option on this stock or ETF that we love. For example, let's say we have Alphabet and it's at $170 per share, and we decide to sell a 160 put that's out 1 month or so from now, and we collect maybe a $200 option premium on this. And we do this again because we love this stock. You're going to continue to hear that because I think it's so important. And we're going to continue this process each month or so, assuming these options expire out of the money, right? That's simple, easy money. That's how we love to sell puts. Now, if we are unfortunate and sell this out of the money option during a sharp decline, we might have to take assignment since the stock is well below our strike price. Now, step two, in my opinion, you should roll this option to continue to collect time decay, provided the return on our roll makes sense. So in this example, we might buy to close our existing put prior to expiration and sell a new put with more time and maybe even a lower strike price if the overall return on the option makes sense. So we want to avoid assignment if possible and pick this up at even a lower price if the numbers make sense. And this is where it's so important to track all this information and understand what your break-even point is and what your return is overall in this trade. Now, once it no longer makes sense to roll the option, and I'll show you an example as we go through this, we will accept assignment of this stock or ETF again that we love. Now that the shares have been assigned, we can move on to step three. So after assignment of the shares, and remember, one contract equals 100 shares, we'll see those shares in our account. We will start to sell out of the money covered calls. They're covered because we own the shares, preferably at or above our assignment price. So our hope here is to collect time decay again from the sold option and hopefully some stock appreciation as well from selling the call above our initial assignment price. Again, it's important to track this information. And maybe even we pick up a stray dividend along the way while owning the shares. And that moves us to step four, which, like step two, my opinion is you try and hold the position in most cases. So continue to roll out and up to keep the shares of this stock that you love if possible. You can certainly deviate from this and focus on maximizing option premiums, option income, but I love seeing some price appreciation myself. So this is kind of a decision tree moment, right? Which way do you want to go? Do you want to focus on the income? Do you want to focus on potential gains in the stock as well as maybe hitting a income target? You just have to consider your own personal situation, and things like taxes, for example, should factor into that and how you proceed with this particular trade. And finally, step five, if the shares do get called away or you allow the shares to get called away and you still love this stock, you repeat the process. And these are the wheels on the bus as they go round and round. So this is the wheel strategy, and you can do this all year long with stocks and ETFs that you love. Now, if any of those steps 1 through 5 were confusing to you as I'm talking about selling puts and selling calls and these types of things in assignment, if that's confusing to you, I have a video. This one's an hour long. There's plenty of others out there too. You can go check them out. This one I did not too long ago. It goes into the basics, right? Buying and selling puts and calls, breaks it all down, shows examples that should help you fill in some of those questions that you might have. So you can check that out as well. But yeah, that's the wheels on the bus. And now I gotta go give the dog her medicine. Anyway, so why should you consider using the wheel strategy? Well, in my mind, this is primarily an income strategy. So with stocks that we love, maybe stocks that we already own, this is different enough from just buying and holding those particular stocks. It's different enough that it's going to give us different results in different markets. So in our example today, it's all about Alphabet. So I own Alphabet. I've owned it for a long time. I've got my set amount of shares. So let's say I wanted to add to that position. Well, I might start out by selling a put, right? And if those shares get put to me because the stock continues to drop, then I'll own even more Alphabet. Maybe I don't want that. Maybe I want to actually use some of this position to generate income. Again, we're back to the income generation idea. So then I'll start selling calls against that small portion of my position, and I can generate some income. And if those shares get called away, it's okay. But if we stay in a flat market, this is generating some income for me while Alphabet's not doing anything. So it's different enough from what you would normally do by buying and holding that I think it can make sense for some people to utilize this strategy in their portfolio. So what are some of the positives and negatives of the wheel strategy? Well, if you go with a single stock, you have single stock exposure. That can be a problem. If you sell calls against a position that you have, you can cap your upside so you can miss out on large moves. And you're going to see that exact problem in my example. I missed out on a big move. It can also be expensive with certain stocks. So if you have a stock trading at, I don't know, $400 a share, then you're talking about one put contract costing you $40,000. It can be very expensive. And it does take time too to manage. So you're going to be actively managing these positions. So you have to be actively involved with these trades. Now, on the positive side, this can give you outsized returns in certain markets, and especially when you include volatile products, which doesn't mean go find the most volatile products. That can be a big negative as well. You want to come back to the idea of I really like the stock and here are my reasons behind that, or this ETF. But it is a component. So when you're really looking for some of these outsized returns, volatility is a component of that. And then certainly the income factor. So if you like to buy very stable stocks, maybe they offer you a 2 or 3% dividend, this can really boost that income with those option premiums. And you can go from a 2 or 3% dividend stock to a 10 to 15% distribution rate from wheeling that stock. So how do we pick the right stock or ETF to deploy this wheel strategy against? And I would say for individual stocks, it's a little bit beyond the scope of a simple video like this, except to say that if you're not willing to own it in your portfolio, then you don't want to wheel that stock as well. Don't go out and just say, well, this one has a really large option premium, so I'm going to wheel this particular stock. I think that's a recipe for potential disaster. So I would stay away from that idea. I would say, I love this stock. Here are my reasons. I would own it, and I'm going to wheel it against a certain portion. So my example today is with Alphabet. As I've mentioned, I've owned the stock for years, and I'm long Alphabet. I'm going to keep it. So for a certain segment or a portion of those shares, I'm willing to wheel that to generate some income off that particular individual stock. Now, when it comes to ETFs, broad-based ETFs, it's a lot easier. So if you own a ton of the S&P 500, for example, and you want to apply this to a certain portion of that or the whole thing, you could certainly do that to generate income. I would say that one issue certainly is the cost. So I get that. So QQQ right now is at $570 per share. SPY is at $645 per share. So that would be $57,000 to sell one put against QQQ. It would be $64,500 to sell one put against SPY to start the wheel strategy. So that's very expensive for a lot of people. So you might look around for some other options that would be similar to that. So SCHG right now, that's not too far from QQQ, and that's trading for $30 per share. You're probably not going to have as liquid of an options market, but you could still wheel that, right? So instead of $57,000, we're talking about $3,000. And then there's SPLG, which is a S&P 500 ETF that trades for $75 per share. So $7,500 to get started with that against the S&P 500. So again, you can still own, right, VOO and a ton of that. You can apply the wheel strategy to something like SPLG for a lot less money and a smaller portion of your portfolio, and it might all work out well for you. So that would get you started. Now let's jump in and take a look at a real example of the wheel strategy in action. The good, the bad, the ugly. And again, our example here is going to be with Alphabet. And this is an example of the information that I kind of collect along the way. So I track this information so I know what my basis is. I know what my break even is. Okay, so I want to know this information so I can make calculated decisions along the way. So back in February, I decided to sell a put, and I've been doing this previously too, collecting some income off of Alphabet, but I didn't put those in here. And all this is going to be with one contract. But I guess first thing is, February, was that a good time to do this? No, because the market collapsed, right? This is when we started to have a big downturn. So sold a 321 expiration with it at 193. I sold a put with a 175 strike price, right? 9% out of the money. And this was a sign. So we start the wheel strategy. For doing this, I collected a measly $134, not a whole lot of option premium in that trade. And it was assigned to me, okay? So I ended up picking up those shares. So once I knew those were going to be assigned on 321, the day before, I sold a naked call. I know, very brave. You don't need to do this. You can wait for a full assignment. And I sold a 417 expiration 175 call, right? Same strike price that it was assigned to me at, which was 6% above. So on this first trade, we went from 193 all the way down to the price at the close was 165. So a dramatic drop during that little over 1 month period, about that 5 or 6 week period. So obviously this thing's dropping like a rock. It gets assigned. And now I'm trying to scramble to collect some of my income again. But we'll see how it turns out. So for this one, I collected $184.32. And I closed this on 3/31. And to close it on that date, it cost me $25.03. Okay, so at this point, I've got a running gain up around $300. And let's see, I closed this on 3/31, and it looks like I opened up another one on 4/4 with GOOG at 150, all the way down to 150 from where we started at 193. And again, I'll put that graph up there from Seeking Alpha. Again, I'm a Seeking Alpha affiliate, and there are affiliate links down below if you're looking for a stock and ETF research tool. It's a great one to go with if you're looking for something like that. But back to this, hop back over here. Went from 193. Plummeted to 150, and again I sold a call at 175 at the assignment price. So I was holding steady, even though that was 16% out of the money from where we stood. And again, that's out around 5 or 6 weeks, and I collected $154 for this. So more volatility. So you can see the time here is similar to the time here, but we're 9% versus 16% out of the money, and I'm collecting more of an option premium, right? So that means more volatility is now in this particular option. That one expired, okay? So this one expired. So now I'm sitting around $450 that I've collected an option premium, but I'm obviously was assigned at 175, and the stock is considerably lower, right? I've lost about $2,000, over $2,000 from where it was assigned to me at. So again, down overall. Then on 5/16, I sold a 620 call at 180, okay, with the stock sitting at 167.47. So now I'm looking for some price appreciation in addition to some income from selling the call. And for this one, I collected $185.32. But I decided to close this one just right before expiration at 6/18 with the price at 175.39. So still below my strike price. And that did cost me $13 to close that a couple days early. So overall, I made $172.29 on that one. So I'm up $620. Okay, so still working on the call side here. So then 6/23, I sold one contract for 8/1. With the stock at 165.92, selling a call at 180, same strike price. Again, that's 8% out of the money, so I'm feeling pretty good, right? Is this thing going to continue to rally? And for that, I collected $294 in option premium. And we see what happened, right? It went from 165 during this period all the way up to 191 when I closed it here on 7/23. So now it's well above my strike price of 180. So now that decision tree comes into play, right? Do I want to try to hold on to this, or do I want to exit the position, let it get called away? So I rolled this 180 out to a new 180 on 7/23. The cost to close that cost me $1,325. Why was it so much? Because it's well above my strike price, right? I sold the 180, it's at 191. That means it has $1,100 of actual real value, plus a little extra value in there for time till expiration, because I did this on 7/23 when I had sold the 8/1 expiration. So I have to pay for that. So it cost me a lot of money. But because I'm selling in the money call, I'm actually collecting a lot too. Almost $2,300 for this one that I most recently rolled out. And I rolled it all the way out to 12/19 to collect as much as I can, because I kind of think this is just going to get away from me. So I'm going to look at the overall return and say, am I happy with that? And in this case, that was my decision. Again, I own a lot of shares of Alphabet, so I'm okay giving this up. So overall, after collecting that, if I let this get called away with this 12/19/2025 end of the year expiration, I will have a running gain overall of $1,888. Okay, so here's my little summary down here at the bottom. Premium collected is at $1,888. Price appreciation, $500, because I'm selling it at 180 when it was assigned to me at 175, giving me $2,388. That's my total gain. And this is in a taxable account. So I threw in my estimate, right? At 35% tax rate estimated, maybe my after-tax gain here is $1,552. So over this total trade dates of 317 days that I was in this, that will give me an after-tax return of 10.21%. Yay, right? It feels pretty good. That's all right. Now the current price, this is the negative, and this is what's so important, and people should point out to you if you watch any other videos, is that the current price as of 8/29 when I'm making this video is $213.53. So if I did nothing during this period and just let this thing rally, the assignment price at 175, I mean, since that assignment, it's up $38.53. So if I just didn't do anything, my uncapped price appreciation right now would be $38.53. And I could be considering selling a call to collect some more income. So I definitely missed out on a lot by capping the upside with this particular wheel strategy here at the end. So that rally that we've had over the last few months with this particular trade really hindered the total return that I could have had by just sitting back and relaxing. Now, in summary, I own Alphabet and I have plenty of Alphabet. So this, for me, was an income strategy. So if I ignore this, I'm pretty happy. If I ignore this, I'm pretty happy with this, right? That 10.21% return. So who knows? I also have till 12/19 of 2025. So who knows what happens between now and then to Alphabet stock or the broad market. And I can also have the choice. I've got time to decide. I'm not worried about this getting called away. It could happen. Low chance right now of it happening, especially since Alphabet doesn't pay a significant dividend. I have time to decide what I want to do here. So I can also close this and offset my gain here with some losses, with what would be a big loss in the option, and decide how I want to play that. Because I might want to look at my taxable gain here and decide what I want to do there. So that's, again, a decision that I have to make, but I don't have to make it today. I can decide what to do going forward. So I do enjoy this strategy, and I deploy this strategy regularly. And if you follow along with my option content and read some of the comments, there are people that love this, and this is what they do to generate income. In lieu of a lot of the option income ETFs that we discuss on this channel, if you want to handle this yourself, it can really work out well. And it can help you understand those products as well. But it does take time and effort to do, and it can be expensive. So it has to work for you and fit in with what you're doing. Now, if you have any questions on any of this, please ask down below. If you like this type of content, like and subscribe. And if you want more option content, I've got this one on a nice little story around NVIDIA earnings. It's fun. And nobody watched it, but I really enjoyed this one. So go check it out. And I also have this one down here, which is probably like put ratio spreads. I'm just thinking off the top of my head. So you can check one of those out. And otherwise, have a great weekend. Start of college football. Love that. And enjoy yourselves, guys. Take care. Whoop.